Field and a lot of newcomers, so everybody's welcome. Today, this highly knowledgeable panel and you, the audience, are going to be discussing one of the most important issues in corporate taxation, and that is profit shifting by multinational corporations into low-tax jurisdictions. Now, my name is Marty Sullivan. I'm the Chief Economist at Tax Analyst, the nonprofit publisher of Tax Notes International, and State Tax Notes, and a lot of other great publications. Now, it may sound like an arcane detail that only tax lawyers and law school professors should talk about, but profit shifting is not a detail. It is one of the most central aspects of corporate taxation. Consider the following facts. Year after year, it is the #1 dollar issue at the IRS. Year after year, when they poll tax directors, what's their #1 issue? It's transfer pricing and the allocation of profits across international borders. At the JCT, when they did their analysis of Chairman Camp's tax reform, they estimated, and correct me if I'm wrong, that 20%, they attributed a 20% loss of the U.S. corporate tax base to profit shifting, and I think other reputable economists have estimated that number even higher. Around the world, governments are engaged in austerity programs where they're cutting back on expenditures, and when you cut back on government programs, citizens don't like that. And then you start saying you have to raise taxes. And when the citizens find out that corporations are not paying their fair share, well, they get very interested. So this issue is getting more and more attention around the world. And then finally, when you think about corporate tax reform here in the United States, well, you always hear about we're going to lower the rates and we're going to go to a territorial system. But an essential element of any realistic tax plan is some sort of rules to prevent wholesale profit shifting by multinationals. So this, let me reiterate once again, this is not the detail. And we have a great panel here today to discuss these issues. They are, experts in their field. They're really nice people to talk to. We're going to learn a lot. Joe Huddleston, right here on my left, is Executive Director of the Multi-State Tax Commission. Before joining the MTC, Joe served as Commissioner of the Tennessee Department of Revenue. Among his many other notable accomplishments, Joe served as President of both the Federation of Tax Administrators and the Southeast Association of Tax Administrators, and he was the Chief Financial Officer for the Metropolitan Government of Nashville and Davidson County. I imagine you have a lot of good stories about that. To Joe's left is Michael C. Durst. He has been a member of the District of Columbia Bar for more than 30 years. He has served as an international tax lawyer both in private practice and for the Internal Revenue Service. At the IRS, Mike was head of the Advanced Pricing Agreement Program. He currently serves as contributing editor for Bloomberg B&A, where he writes on international tax and transfer pricing issues. And Mike also serves as a researcher and consultant on tax administration and policy needs of developing countries. And further to the left is Dr. Mike Udell. He'll be joining our conversation. He is an economist with a PhD from Caltech, and he is the founder of the District Economics Group. Before founding DEG, Mike worked on tax policy issues at Ernst & Young, and before that, he served on the staff of the IRS, like many other people in this room, and before that, after that, he served on the prestigious staff of the Joint Committee on Taxation. So we have a great panel here. This seminar is sponsored by salesfactor.org. Salesfactor.org is a group of individuals interested in fixing the corporate income tax system. The website is funded by Bill Parks. Where's Bill? Bill Parks, a retired finance professor and business person. The website posts information on sales factor apportionment and as an approach to leveling the playing field between domestic and multinational corporations and improving the competitiveness in world markets. And before we get into the meat of it, I would like to thank very much Aditi Bashist of the District Economics Group for all of her wonderful help in putting this together. Now, before we get into the details, I spent 3 decades working on transfer pricing. I'm going to tell you everything I know in 3 minutes. Because you can get lost in the weeds very quickly, but I think in the end, it all comes down to a little bit of common sense. So, multinational corporations do business in many different jurisdictions. These different jurisdictions have different tax rates. So the name of the game in tax planning is to get as much profit into the low tax jurisdiction and out of the high tax jurisdiction. And since now the United States is the highest statutory rate in the world, that pretty much means getting money out of the United States. So how do you do this tax planning? Well, U.S. multinationals, the parent companies and their subsidiaries engage in lots of transactions with each other. They sell goods and services to each other, and they have to charge prices to each other. So let's say you have a U.S. parent tech company and an Irish subsidiary, and that Irish subsidiary manufactures, let's say, computer keyboards, and you have to transfer those back to the United States for sale. Well, if you can get the price of those keyboards, that transfer price from Ireland to the United States to be high, well, then there's going to be a lot of profit in Ireland, and there's going to be correspondingly less profit in the United States. And that is, you don't need fancy tax shelters or elaborate tax planning. You just need to adjust that price. And so this has been the name of the game for many, many, many years. And if it was 10 or 15 years ago, I would just stop there. But the world's gotten a little more complicated in the last decade. So we'll go to the next slide. But what's changed? Well, we all know the world has become more international, business has become more international, capital is more mobile. But the 2 things I would like to focus on are that so much more of value creation in the world is not bricks and mortar, it's about intellectual property, patents, technology, trademarks, what we call in the biz intangibles or intellectual property. 2 things to keep in mind about intellectual property. It's highly mobile, unlike a steel factory. And also it's very hard to value. And these are 2 features which are just great for tax planners, because what you can do is instead of thinking about the U.S. parent where the headquarters is and where all the research is done, or the foreign subsidiaries where most of the sales are and most of the manufacturing is, those are usually countries with real tax systems. What you can do is you can take those intangible assets and transfer them to a tax haven holding company at a relatively low price, and then that tax haven holding company can charge royalties to the subsidiaries and to the parent companies where all the real activity is taking place. And so that's why companies in the pharmaceutical sector and the technology sector have such low effective tax rates. They have so much intellectual property that lends itself to this type of maneuvering. And there's another very cute development. Since Chris and I were doing transfer pricing 2 decades ago, they didn't have any of this. They have something they call risk shifting, where they write contracts, related party contracts between subsidiaries, between affiliates, and they say, oh, the low tax, the subsidiary or the holding company in the tax haven, well, it's assuming a lot of risk, so it deserves to have a lot more profit assigned there. And so the manufacturer in the manufacturing subsidiary, which is usually in a mid-tax country, or the sales subsidiary, which is usually in a high-tax country, well, they're not really doing that much, so there shouldn't be that much profit there. And so what you end up with is a situation where you have a lot of stuff going on in the U.S. You have research, you have all the execs there, all the planning's done there. And then you got the foreign subs in countries like Japan, UK, Germany, Italy, countries with real tax systems, where the manufacturing is being done, where the sales are taking place. But then you have most of the profit in a tax haven or a low tax jurisdiction where there is either no activity at all. It's just a shell corporation, or it's just a company with just a few employees. So we have two ways of policing this type of profit shift. The overwhelmingly dominant way for the last 5 decades has been something called the arm's length system. And here's where the US regulations have the arm's length standard, our 60 tax treaties have the arm's length standard, the OECD treaty has the arm's length standard. And what it says is, when you do these transfers between subsidiaries of a corporation, well, you should do that at an arm's length price. And what that means is, imagine, if you can, that these two entities were separate entities and that they were engaged in a market transaction. Well, the problem with this, and I won't dwell on it, but take my word for it, is there's a wide range of possible prices that very smart economists can come up with. And very small adjustments in those transfer prices can make very large differences in the profit allocations. And so the arm's length system, when you look through the data and you see that there's profit rates 3 or 4 times higher in Ireland than there are in Germany, and you see that there are tremendous accumulations of profits in tax havens, the arm's length system is not putting the profits where the economic activity is. Which brings us to the second way of doing things, which is the formulary method. And the formulary method is very simple to understand. You look at worldwide profits, and you say, what's the fair allocation of these profits? And what you do is you look at, see, where is the real stuff? I'm using a technical term here, stuff. Where's the real stuff happening? And if you look at this picture, well, the real stuff is happening in the United States, where the headquarters are, the research is. And the real stuff is happening in the foreign subsidiaries, where there's manufacturing and sales. But there ain't no real stuff happening in the tax haven. And so we would not be allocating a lot of profit there. The type of stuff that is actually being measured would be either sales, or assets, or property, or employees, or workforce payroll, but real tangible economic activity would be used to allocate these types of profits. There has been very little discussion, or relatively little discussion, of the formulary method in policy circles. It has been dominated by the arm's length method. And that's primarily because the US Treasury Department is, how can I say this? It just absolutely is wedded to the idea of using the arm's length standard and rejects the formulary method. The business community loves the arm's length standard because it allows them to shift profits into tax havens. The transfer pricing community, which is a huge cottage industry in this town and throughout tax practice, they love the arm's length standard. And what we're going to try to do today is give you a little bit, try to level the playing field on the debate a little bit and talk a little bit about the formulary method, which is relatively unknown and needs to have a more thorough area. So we're going to start off at and by the way, the formulary method is not something dreamt up by academics. It's not a theoretical construct. It's been used by the states for
100 years.
Well, this is Joe. Why don't you take it from there and tell us what the states have been doing?
Okay, as I begin this discussion, Marty, I want to make a couple of broad-based points, beginning with the fact that the opinions I expressed today may or may not be the opinions of the Multi-State Tax Commission or any of its member states. They are my own and my own exclusively. What I'm going to talk about is a little bit of the history of formulary apportionment. As Marty kind of laid the groundwork for this discussion, this is not new. So I think it's important to understand that as far as tax policy is concerned, tax policy is always behind the curve. Always behind the curve. And when I finish, I'm going to come back and I'm going to say that to you again, because what we find now is that in the discussion of formulary apportionment and other issues, what the states have been doing for literally over 100 years is now met by amazement by some of our international friends. But I want to start with the discussion of corporate tax. I'm sure many of you in this room are more than aware of the fact that state and corporate taxation just basically didn't exist in this country prior to the turn of the 20th century. The only way businesses were taxed were basically the only way that anybody was taxed was on a property basis formulation. If you owned property, if you owned that property inside the city limits, you were taxed at one rate. If you were outside the city limits, you were taxed at another rate. In some jurisdictions, if you had multiple closets in your house, you were taxed at a rate based on more than one closet. And the variation of the formula of how property was taxed was as broad as there were municipalities in the country. That's not how business did business in this country for very long. I'm a native Tennessean. My first president from Tennessee, Andrew Jackson, it said came to Washington with horse and buggy. That was in 1828. 8 years later, when he left on a train. Now, if you can imagine the evolution of what was going on in the business community that changed the world so dramatically in those 8 years, let me suggest to you that that was nothing compared to the change we've seen in the last 8 years or the last 20 years. The nature of how business was carried on in this country dramatically changed by the late 1800s. And we found that instead of being business enterprises that were very local in nature and taxed basically, as I mentioned before, on a property tax base, they became multi-state businesses. As the Vanderbilts and the Rockefellers began to expand their empires either up the Hudson or out into Ohio and across the country, the nature of how business was carried on began to change fairly dramatically and fairly quickly. By the end of the 1800s, the nature of how business was carried on was completely different. The big businesses were truly multi-state in nature, and many of them even then were multinational in their structure. By the turn of the 1900s, many states began looking at the railroads because the railroads were the most obvious structure. Let's go to the first slide. The railroads were the first obvious structure that were truly multi-state in nature, and their assets were multi-state assets, not only their tracks, but more significantly for this discussion, their movable property became issues in a variety of states. How you valued those and how you taxed those and whether they were even a component piece of the base. So in the early 1900s, the property tax base became an issue of major discussion. And if you look around the world today, you're going to find that the property tax base is a major issue of discussion outside of the G20. So the issue became, how do you tax movable property? The states began to develop methodologies that I'm going to suggest to you before I'm through are almost identical to many of the issues that we face on a national and international basis today, over 100 years later. Those same issues are prevalent in our tax structure. So the states began to look at the rudiments of formulary apportionment. The first things they looked at were only natural. They looked at property and payroll, which is what they've been looking at since the 1700s, and how businesses were carried on. As I suggested before, this was an element that was well behind the times when it first came into existence. So we began with property tax formulations, and those activities included both their fixed assets and their movable assets. The solution, we saw that formulary apportionment took all of the railroad assets subject to property tax in state A, and they made a ratio out of it. Those assets in one state over assets held everywhere, including all of their movable assets. And that formed the basis for a property tax base. But that same idea early in the 1900s began to gain traction in corporate income tax generally, because by then we fully understood that the nature of corporate business was not locked down in a single jurisdiction, notwithstanding the fact that payroll and property were still the key elements that we were dealing with. This slide just demonstrates to you how the federal tax base looks at your people wherever they are, your manufacturing concerns, if that's what it is, any of your processing, your distribution areas nationwide. They roll those up into one consolidated base and you get taxed based on that. That's fundamentally different than what the states do. The states look at all of the components of your business enterprise, wherever that is. And if you carry out your manufacturing in one state and your personnel activities are in another and your distribution in another, the states tend to look at all of those in a single base, and then they begin to look at the key formulary components of payroll, property, and sales. And how do they do that across the base? Well, we'll get to that. By the middle of the 20th century, the concept of formulary apportionment was widely accepted by the states. In fact, of the 44 states that had corporate income taxes at the time, every single one of them used formulary apportionment in some structure to be able to tax their industries. It was generally done across two different bases. One could be viewed as geographic accounting, where they calculated profit and deducted expenses for each individual state. Separate accounting methodologies. The other looked at total income and divided among the states using a formula to reflect the activity in those states. And again, that reflection of activity was based upon those equally weighted factors of payroll, property, and sales against those same factors everywhere in the country. Now, this lasted for quite a long time. As I mentioned before, business was rapidly changing, and through this period of time up to the mid-70s, businesses increasingly became focused on intangibles. Certainly after World War II, the nature of how businesses were carried on with the growth in intangibles was pretty dramatic. By the mid-70s, we were still in an equally weighted formula across most of the country. But by the late 70s, Iowa decided to move in a slightly different direction. They eliminated the payroll and the property components because they viewed themselves almost exclusively as a market-based jurisdiction with very little manufacturing. The courts throughout this period of time and later have looked at the issues of formulary apportionment, whether it was with the Exxon Corporation versus Wisconsin in 1980 or Allied Signal in 1992. The courts have both blessed and given all sorts of direction in the area of formulary apportionment. But by the late 70s, as I mentioned, Iowa set off on their own and went to a single sales factor, trying to capture the market that they viewed themselves as. We see these same issues across the world right now as those market-based countries see some need to protect their tax base. Here's how the formula was created. By the 1950s, the states got together through as a result of a congressional committee discussing taxation, state taxation in particular, the Willis Commission, and the original proposal that came out of these commissions and these concerns was, again, two-factor, payroll and property, but it really didn't meet the needs of the states, even in the 60s. Certainly not by the 70s as states began to evolve, and states became much more concerned with market jurisdictions and market activities. So the state variation came back to where it began, payroll, property, and sales, until Iowa set off on its own. The court in the Mormon decision said that the single sales factor was acceptable because what the states were looking for was a rough approximation of actual business activity in that jurisdiction. It was not a to the third decimal point accuracy. It was get a rough approximation, and as they say, that's good enough for government work. And that held up pretty well, except by the time the Iowa case was decided in Mormon, there was really beginning to be the floodgates had kind of opened in terms of market-based issues. And so over the next 30 years, states began to double weight the sales factor, triple weight the sales factor, and in the last 10 years or so, go to a single sales factor, much like Iowa had done, California being the largest and most recent state, I guess, to go to a single sales factor. There's lots of reasons why states did this, but it actually reflects in my mind the actual implication of how business has changed over time. And you're going to see those exact same issues in the discussion of how international tax is relevant and how tax structures, I believe, must change to be able to deal with them. Each of these factors is a factor of the payroll, the property, or the sales in relationship to those same factors, either nationwide or worldwide. Now, I'm not going to tell you that that arm's length pricing doesn't work within its own framework. It may. But what I am going to say to you is that it's terribly problematic for any number of reasons, and I'm sure when we get to the questions and answers, you're going to have some questions about that, and I'm going to talk to you about why I think arm's length pricing is really problematic and not a good solution for the 21st century. So I want to end where I began, and that is that government entities that deal with taxation are always behind the curve. We're dramatically behind the curve right now. And as we look at what the EU has done and the way the OECD has worked, again, I'll caution you that this is my opinion. I don't believe that where they are really reflects where business enterprise is. And I think it would be a mistake for us to compare ourselves to the European Union in terms of overall tax structure and say, gee, we ought to be like that. We have a unique opportunity to be the way we need to be and to address how business is carried on here and around the world. And I would encourage you to give strong consideration to the elements of formulary apportionment, because many of the issues that are being raised now in this discussion are issues that have been raised decades ago and have been addressed and largely answered. Yeah, I think there's probably only about 10 or 12 states that still use an equally weighted factor apportionment. So you're right, there's been a large movement away. In being somewhat cynical, I would say that most of the states have done that through what they perceive to be their own economic advantage. They understand that their constituencies, being manufacturers perhaps, or industries based in their state, feel like that they can do better if they don't have a payroll or property factor in their base, and they only have to pay based on sales.
So they're not taxing their own businesses. They can't be accused of being
It's the tax the fellow behind the tree
hurting
concept.
job creating businesses.
Exactly.
There's another dimension to that as well. States are always eager to attract employment, attract investment in plant and equipment, and if the apportionment formula says basically that the more people you employ or the larger your payroll, the greater your taxes are going to be, it is perceived as discouraging companies from investing in the state. So all states end up engaged in what we usually call tax competition, where they stop imposing what are perceived to be tax penalties for creating employment, for creating plant and equipment, and that's where the payroll factor goes and the property factor goes, and what's left is the sales factor. The thought being that the sales base is not very mobile in a state, so you're not going to be chasing away business by basically imposing tax on sales in the state. That phenomenon has been extremely strong, and it's dramatically changed formulary apportionment over the last 25 years or 35 years, really, and since the Mormon case. And it is also something we need to talk about quite carefully today when we talk about international formulary apportionment, because countries have the same incentives toward tax competition as the states do, and really, this is the first step in our discussion when we're seeing that there's a lot of complexity to this. There's complexity and there's simplicity. I mean, there are some simple points. There's a lot of tax avoidance going on by shifting income, there are also a lot of political factors that underlie the current system, and we need to look carefully at those.
All right, so just let me quickly add. Remember in Joe's discussion about the states, the notion of clear reflection of income sits at the top of how you're going to construct your tax base. You can get away with a single sales factor apportionment in much of the United States because we have such an enormous sales-based economy. You still get clear reflection of income. And so that's why many states go there. There are some states that won't go to a sales factor, single sales factor apportionment, largely because it wouldn't be a clear reflection of income. And the reasons would be many of the reasons that will show up again on the international scene. There'll be reasons of, well, we don't do a lot of sales here, but we sure do a lot of economic activity in the state. My best example being North Dakota, where they do an awful lot of oil and gas activity, when they don't really do very much sales up in North Dakota. Single sales factor wouldn't be a good rule in North Dakota. It wouldn't provide a clear reflection of income. Those are good comments.
Yeah, and I guess I would say to you that from my perspective, at least, formulary apportionment is a tax policy structure. How you slice and dice that going forward relative to your own political circumstances is a public policy consideration that I may like or dislike, but I would say it's not really my call.
So I'll turn it over to Mike Durst.
Yeah, what Joe said just a moment ago is, I think, terribly important, which is that formulary apportionment as a conceptual means of running an international tax system or even a multi-state tax system has a very important core. What it says is that income has to be booked where activity takes place. Under a formulary approach, which we can define very broadly, as Joe just did, there are many, many ways to skin this cat. It's impossible to do what companies are now allowed to do under the arm's length standard, which is to move a lot of income to lower zero tax places like the Cayman Islands and Bermuda, where nothing happens. That phenomenon has grown dramatically over the years as both the regulations around the world, including the U.S. Treasury regulations, and court opinions have interpreted the arm's length standard as giving respect, as giving deference to those transactions by which, say, a company in Germany pays royalties to a company, a commonly owned company or a related company in the Cayman Islands or Bermuda. Basically, court decisions around the world have interpreted the arm's length standard, this fictional world under which we treat related companies as if they weren't related, as allowing that kind of thing. It's become deeply entrenched for political reasons. Now, you can wipe it out overnight by putting in any kind of formulary apportionment, including the simplified kind of formulary apportionment, which I suggest in the paper that I circulated outside. And by the way, the way I tend to work, I come up with ideas, some good, some not, and depend on others to point out the good aspects and the not so good aspects of them. So anybody who's inclined to read that paper and give me a call or send me an email, it will be received gratefully, and even if I disagree with you, I won't say so. I mean, I'll be nice. But the point is that any kind of formulary system would make what the OECD has called base erosion and profit shifting impossible. And it's for that very reason that anything remotely related to formulary apportionment has been politically very, very unpopular. And here's the key, and here's what's so important for people on the Hill, who I'm sure are familiar with what I'm about to say. It's not only businesses that have been very strongly opposed to formulary apportionment, it's governments as well. Because the corporate tax has always been a very problematic animal in terms politically and economically. And the United States, some elements are, from a US government perspective, from certain government perspectives, it's just fine for US multinationals to be able to do business in Germany or Kenya or any other country and avoid local taxes by shifting income to the Cayman Islands or to Bermuda or similar places, because that is perceived as allowing US-owned multinationals a competitive advantage. They can do business around the world and pay taxes at much lower than the statutory tax rates in those countries. And that's perceived as an advantage to U.S. business. That's how this, very often multinational companies will defend this base erosion and profit shifting structure that we have. That's the reason why very often businesses will strongly defend arm's length transfer pricing, because it allows that kind of thing. Now, what about the government of Germany or Kenya? Why do they allow this to happen to them? Well, it's because all countries in the world are typically eager to attract inbound investment. So if the government of, say, Germany or Kenya can sort of just look benignly at this shifting of income out of the country, what it's doing is it's making it possible for inbound investment to come in and get an implicit tax exemption or partial tax exemption. And that also has very strong political appeal to governments as well as businesses in some countries. One can argue that all of this reflects the impossibility of imposing a corporate tax at a reasonably high level in a world economy with mobile capital. And that a lot of what we're doing here, we're trying to fight the trying to fight the difficulties that are inherent in corporate taxation when you can move activities and capital around the world pretty much at will. And that creates a huge political and economic problem. It's a shame that so often this problem, the real elements of this, the political and economic elements, have been obscured by what one might call spurious technical arguments for or against arm's length standard versus formulary apportionment. A lot of that is just basically a cloud of words that try to sort of obscure this basic fight over whether there should be a corporate tax imposed on income from cross-border activities. What I could say, based on a long time of being in the trenches working with these laws, is that in order to stop base erosion and profit shifting, which is what BEPS, it's what the OECD calls this tax avoidance phenomenon, it will be necessary to develop rules that are a lot more like formulary than the rules we have today. As you'll see from my paper, there are a lot of different ways you can do this, some of which I think are administratively a lot simpler than explicit formulary apportionment. So if we want to have a corporate tax that's effective, we'll have to move toward some type of formulary approach or some quasi-formulary approach, like as I've suggested in my paper. What the IMF has called hybrid transfer pricing methods. By the way, a great explanation of all this is in an IMF paper from a few months ago on so-called tax spillovers, and it approaches the question from the perspective of developing countries, which I think is quite helpful, and it's well worth reading that paper. But so I think technically one can do it. The question is, politically, do we want to do it? I think that the only real chance of getting reform will be some type of very comprehensive corporate tax reform, which lowers the rate of the corporate tax to such an extent that companies aren't fighting against it quite so hard.
Let me make two comments on that. First is that I think it's important to understand that the issues of tax benefits in economic development are always discussed but largely overblown. I've never seen a study that puts tax benefit in the top 5 of anybody's survey as why they move, why they establish, what they do. There's so many other business-driven motivations for why businesses locate where they are, both in multi-state discussions and in multinational discussions. I'm not saying that taxes don't play a role. They certainly do. I mean, you're intelligent, qualified planners. You look at all these issues, but is it at the top of the list? Is it second or third or fifth? No, nobody says it is. So I just say, don't overemphasize the importance of that. And the other thing that I would point out, I had the opportunity last week to speak at a very fine multi-state tax conference sponsored by Deloitte down in Florida. There was a large group of state tax practitioners there, and one of the issues that was pointed out was that, and I don't know if this number is correct, but they said something like 65% of the total corporate income base is in intangibles today. If that's true, or if it's even close, the nature of utilizing arm's length to value intangibles does not make good sense.
So, Joe, are you saying that if arm's length worked maybe 30 years ago, it may not be working so well now?
Well, I would go a long way before I ever said it worked very well. But if it ever did, it's certainly less today than it was yesterday.
I mean, when you think about it, there's an inherent absurdity to the whole idea. I mean, what you're supposed to do under the arm's length standard is say when one unit of a corporate group licenses, say, the patent to a drug to another member of the corporate group, you're supposed to get a bunch of economists in the room and with a lot of computers. And believe it or not, companies have to hire economists, and the IRS has to hire economists to do all these, to crunch all these numbers.
We think that's okay.
Yeah, I know. See, you can see how problems start. But and then you spin these computers, or whatever you do with computers these days. I know you can use the old ones, and apply all your economic training. You come up with a market price in a situation where no market actually exists. If it were possible to come up with market prices, using smart economists and computers to come up with market prices in situations where markets don't in fact exist, the Soviet Union would have been the most successful country in the history of the world. It simply exceeds the capacity of even the very best economists.
Yeah, most states long ago stopped including intangibles in the property tax base. Why? Because it was simply impossible to value the intangible. And we find that same thing true in arm's length issues, because arm's length allows people to almost arbitrarily value their intangibles at whatever they want.
So actually, let's just develop this a little bit. So in the original formulary structure, we have payroll, property, and sales. Two of those factors are source, and one of them is a destination factor. And so how does...
So source, you mean where things are made?
Where things are
and
made.
Destination, where things are sold.
Right, and how does the intangibles problem map onto these factors?
That's an extremely important question. The fact is that for the same reasons that that the states have all moved, not all, but most of the states have moved to sales-only single-factor apportionment, which is basically basing the corporate income tax burden of the company on the level of consumption of the company's products in the state. I think internationally, inevitably, destination-based taxation there are strong economic forces toward destination-based taxation, because putting charges on things, levying a tax on productive activities, running plant and equipment, employing people, whatever, in a country is simply perceived as self-destructive from the standpoint of many governments. Remember, if you're a government official in a country, the last thing you want is for a plant, a large employer, to leave that country and point the finger at you while they're leaving. And so this kind of political consideration places an enormous emphasis on destination-based taxation, and that's another way of saying that this concern places an inherent limitation on the level of corporate taxation that you can have around the world, and it's something that people, including I, who frankly tend to look at things from a sort of liberal political perspective, have a lot of trouble with, because on the one hand you want to see the revenues come in, especially to developing countries, because they have desperate needs. On the other hand, if one pretends that certain tax measures are going to work and induces countries to depend on them, but they don't work because of these political and economic factors, you're not doing anybody any favors. So that's why I think we have to move off, I believe, the arm's length approach, but we have to be very careful about what we move on to in order to have a tax system that's going to be sustainable over the long term.
So just to frame where we are right now, I think our panelists are advocating that we strongly consider using the formulary method instead of the arm's length method. And then the next question is, what factors do you use for the apportionment? And Mike Durst was strongly suggesting sales. I think my question, you folks are pretty strong advocates of the formulary method. I just read a paper last week from the very prominent international economist Harry Grubert at the Treasury Department, and he has an opposite point of view. And it's a very good paper, like everything Harry writes. And he has lots of objections, but let me just mention two, and see how we all want to respond to that. The first objection, and I think even advocates of the formulary method acknowledge that this is a major problem, is that we have over 60 tax treaties with all these countries that took decades to negotiate. And all of these treaties say you must use arm's length pricing for your allocation of income. So as a practical matter, even if I love formulary, can we do something like this?
I think Harry makes a very important point, there's a very long tradition of income tax treaties around the world. It would be quite disruptive to try to replace them in the short term. And I think that it's fair to say that if one were to have an explicit type of formulary apportionment where the company reports its global income and then asks each country to take its slice, there are arguments that can be made on both sides, but I think Harry's probably right in saying that most people would think that that's not consistent with the current treaties. That's one of my reasons for suggesting quasi-formulary, or as the IMF would say, hybrid approaches that that have accounting mechanisms similar to those we use under the current arm's length, but still have mechanisms in place to prevent the income shifting, to require a match between where observable economic activity takes place and where income is booked. I also would say that I don't believe that sales-only apportionment is the right approach, especially for developing countries. I think that, and again, this paper, I think, suggests a somewhat different approach. I think there's I think that there are ways to craft a method that don't give up quite as much of the tax base as developing countries would give up if they had a conventional, or a classical sales-only based approach.
Well, that's right, because in my analogy, that's North Dakota, all right? Not that they're a developing country in the United States, but they don't have much sales, and developing countries tend to not have much sales. They're not really consumption-based economies. They're generally resource extractive-based economies. And even today, resource extractive-based economies use a different kind of tax. They put all sorts of levies on a barrel of oil or rubber or tin that's being pulled out of the ground. And our Treasury says, well, that looks like an income tax, so you can use a tax credit. But the point is that that's where the value is that's being created, and so that's how they tax it. And so that will always exist, right? So sales factor or destination-based tax is really simply not a solution for countries or states that don't have a sales base that really reflects the economy. But in the U.S., probably it does.
Let me, since I know the least about treaties of anybody up here, probably anybody in the room, let me suggest a couple of things to you about the treaty problems. One is most of the countries that are signatories of these treaties are Western industrial countries that have a lot to gain by formulary apportionment. And most of those we've seen the evolving trends as the EU countries begin to re-question what permanent establishment is, how it works, and whether it's meaningful in the 21st century. I think I will refer you to where I began this discussion, and that is that tax authorities are always a good 10, maybe 20 years behind the curve in being able to get these things done. And if it is that formulary apportionment is meaningful in the century we're charging headlong into, it's time we started down this road. Yes, it will take time. Yes, it will be hard to do. But by golly, it just doesn't make a whole lot of sense not to start.
Yeah, because of the tremendous political sensitivity of the whole idea of formulary apportionment in recent decades, really a lot of serious research that should have been being done all along hasn't been done, and we're playing catch up now. And because of the sometimes absurdly emotional tenor of the debate between arm's length and formulary, arguments on both sides have tended to be overdrawn and oversimplified. And that's no way to run a tax system. And so what's needed now is, exactly as Joe said, some serious looks at structures that will prevent base erosion and profit shifting, because that's very, very important, and also will apportion income around the world in ways that are as desirable as possible, as fair as possible, and that do take into account the special needs for corporate tax revenue of developing countries. Because remember, developing countries, unlike, say, the United States, are limited in their ability to raise revenue from the domestic economy, because so much of the domestic economy in many countries is informal and doesn't generate a lot of books and records. So developing countries have a proportionally greater need for corporate tax revenues than wealthier countries. And that, I think, puts a special premium when we design this new system of taking into account the needs of developing countries. And to the extent that we can put this debate over words, really, names behind us, and start to do some serious analytial work, the better off we'll all be.
Well, I have lots more questions, but I want to open it up to the floor for folks who want to ask our panel. David.
Hi, Marty. In the United States, the formula apportionment made a little bit easier by the fact that you're starting with the same denominator for everybody, meaning the federal income tax, which is what you're apportioning. The minute you start talking in the international context, you're talking about 100 and something odd countries, each of which have a different set of rules. How do you solve that problem in the international context?
You put your finger on the hardest technical issue in explicit international formulary apportionment. I try. You got to pick up my paper and say something nice. Say something nice about it to me, privately or publicly. But I think you have to. That's why I think you have to use quasi-formulary methods. So what I suggest is looking at the book profitability, say return on sales, return on expenses of the group, then looking at the sales in the particular country, the cost base in the particular country, and applying that book profit level to those in-country amounts, single country amounts. And that's basically how a lot of transfer pricing methods work today. You come up with a minimum level of book income in the country. That's how those techies in the room will know this is the comparable profits method or transactional net margin method. And then you leave it to the taxpayer, as is the case today, to translate the local book income into taxable income using local tax rules. It's a messy process, but it's a lot less messy than trying to convert the company's global consolidated book income into the taxable income under the rules of Germany, France, Kenya, United States, UK. And it's also the same messiness we have now under the arm's length system.
Right. So David, we did that in a paper that came out in Tax Notes, I think last summer, and we basically used book income, which is everyone can see it. I know what General Electric's book income was last quarter, right? And I never know what GE's U.S. tax base will ever be, but I know it. Everyone in the room knows what GE's book income is. And then you use a formula, because the formula is somewhat transparent. Sales are more transparent than some other factors, and allocate. And so that exercise, in a very, very cold sense, is not a hard exercise to do. We can go back into our office, and as long as we have book income measures for companies, and we have more about book income than any other data point, we can go ahead and start applying a formula, whether it's sales only, or in a developing country, whether it's some measure of the resource or the property or even payroll, and go at it. That's actually not as hard a lift to do, at least as a first step.
Yeah, I think that's right. I think you mentioned to begin with that federal taxable income is the starting point for most states before they apportion. It doesn't have to be. It just is, because it's the easiest point for states to get a hold of. And as we look at it on an international basis, I think at least at the very beginning, all these books and records of the corporations that do business worldwide, they largely have that information in one form or another, and we would have to begin by simply, hard to believe, we'd have to take them at their word and start.
If you'd like, I actually written another paper on this that I haven't inflicted on the group here because I wanted to be welcome. But we can chat. It's a very difficult problem, and there's no perfect solution under either formulary or arm's length, I think is the way to look at it.
Yeah, you think the rates would have to definitely go down. I mean, I don't think there's any real connection there. Maybe you're just saying politically it's just a trade-off. But every country obviously could have their own rates applied to whatever income is apportioned to.
It is exactly and only a political thought.
But personally, I don't think that corporations would ever accept formulary in exchange for a rate reduction. I think I think the arm's length method is so profitable for them that there would never be a rate at which they would agree.
You may well be right, but the implications of that are essentially that we need to give up on the idea of taxing corporate income from cross-border activity. I mean, basically, I think another way of saying that is that it's simply politically impossible to do that.
Well, this is a democracy.
Well, but but you bring up an important point, because really the tension in the room is not on corporations, it's on purely domestic corporations versus multinationals. Purely domestic corporations don't have a lot of ways to avoid tax, and multinationals do. And the real tension that's really being discussed is not about corporations in general, but really the difference between domestic corporations and the multinationals. And that's really, there's a fairness issue here that doesn't really creep into the discussion.
Yeah, that same tension is exactly the same tension that we've seen in the States for 100 years. If you're located in a single state or in one or two, it's your rate's 100% of your income, you're going to get taxed on a pretty good chance. But if you're in 40 states, you get to play this game.
Well, but I mean, sometimes it's cast as a disparity between the taxation of brick and mortar and intangibles intensive industries. And the fact is that, going back to the beginning of history, you always try to tax the non-mobile thing. I mean, it's, you try to tax land, not cars or something, because the fact is that there are some kinds of businesses that are intrinsically local, that where you have to make stuff close to where it's eaten or whatever, and those are a lot easier to tax than businesses that can set up overseas. And I mean, one thing about our system now is we allow, by these cash transfers to Bermuda or what have you, we allow the fiction of having transferred business overseas without actually having to do it, and that's been a problem.
You were tending toward the sales only for developing countries.
No.
But, it sounded like that. But
sorry.
how would you apply this? How would you apply your formulary apportionment to Zambia with copper, and with virtually no sales? It's not unlike the Dakotas. The other question is, how do you apply your formulary apportionment to banks and financial industries?
Well, that's an excellent question. And what the states have done over time is that there are a number of specific industries that have specialized apportionment formulas, financial institutions being one of them. And some other industry segments have their own special apportionment structures that are built into the statute. Insurance, for instance, is a completely different taxing structure that kind of sits aside from a lot of these things. Transportation has some specific apportionment formulas relative to that. There's 5 or 6 that have separate specific apportionment structures.
I mean, those industries, it's so impossible to do the arm's length method. They've sort of jumped on board with formulas. I think the first APA ever was a global trading firm.
That's right.
Well,
that's my point.
But let me back up. Just as Marty just said, there are some industries, and we'll get back to mining in just a second, where the sensible means of taxation is to do something other than a full-blown attempt to measure the net income. So a lot of the states impose, I think in lieu of income taxes on insurance premiums.
Yeah.
So, economists will quibble with that in all kinds of ways, but it's proven to be the only effective way of taxing that industry. And I know of at least one country that does the same thing with the insurance. A small and poor country does the same thing. In terms of minerals, that's a really important question. First of all, I personally would want to go kicking and screaming, toss it around a lot before I would push sales-only apportionment for developing countries, because I think that it does put developing countries at a relative disadvantage. So I want to make that clear. And if I said anything that suggested otherwise, I misspoke. But in terms of mining, as a practical matter, the operations of extractive companies are so complicated in these countries, and the difficulty of transfer pricing enforcement is so great that I think that developing countries need to do a better job than they have been of selling their natural resources and making sure to get the proper market price for those resources. I think that the problem of natural resource taxation is a fairly specific problem that also needs a lot more analytical work, even than has been done to date. There's been some good work done on it, but more needs to be done, and we've actually, in another setting, talked about that a bit. Marty?
I'd just like the three of you to compare the so-called territorial tax idea of eliminating all taxes on all foreign income compared to any one of the proposals here.
In the context in which we're talking here, I don't think it makes territorial versus worldwide. I don't think it makes much difference. You still, under a territorial system or a worldwide system, unless you have countermeasures in place, have the ability to park income-producing assets like cash in tax havens. I think that you might argue that going to territorial would make transfer pricing a bit more important, because what used to be just deferral of foreign income becomes now permanent exemption of foreign income. But I really think, given how long companies tend to defer, I'm not sure that difference is all that powerful. I think the key thing is we have to be sure that if we move to territorial, we don't imagine that we've solved the transfer pricing problem, because if anything, we've made it more important.
So, just to follow up on Marty's question, of course now international tax reform is on the front burner, and we're looking at a more territorial type of system, and most folks...
Well, you are. The president is looking at a more worldwide system.
I'm thinking about, okay. But the point I'm trying to make is that no matter what type of territorial, if we go to a territorial system, even the most fervent advocates of a territorial system realize that you need what they call anti-base erosion rules. And so that might be, and now I'll use some lingo, for tax lingo, tougher CFC rules, or the minimum tax that was just been in the headlines this week. Would you say that going to a formulary method might be another alternative approach to preserving the tax base in a territorial system? Or is it something Congress should be considering now as an alternative?
So
right now,
the quick answer to that is that formulary systems are a two-step. The first step is that a base is defined, and then the second step is a formula is applied. In a U.S. state corporate income tax system, the base is defined as the water's edge in general, and the water's edge is the edge of the U.S. So it's not a global income tax base, it's the income somehow apportioned around the edge of the United States, all right? On the other hand, for a U.S. federal corporate income tax, if you defined income not with no water's edge, the globe, if you defined it globally, all right, then the formula that you choose is, at that point you've got the tax base and there isn't the leakage. When you define the tax base globally, your problem is one of, and it's a familiar problem, it's one of double taxation now, because the U.S. does one formula and Kenya does a different formula, and then the issue is, well, is there double taxation? And
I think that's one area where this whole debate between arm's length and formulary has gotten very distorted. Right now, if you're deciding whether to invest in an international business, let's say you're going to be doing a business that's going to involve France and Germany, you have no clue as to the effective tax rate at which France and Germany are going to tax the income resulting from that venture, because the arm's length transfer pricing is so subjective and so indeterminate. So you take a big chance that under the in ways that you can't predict, the two countries are both going to try to tax all the income or a large portion of the income from that activity. And that uncertainty of overtaxation has got to be inhibiting cross-border investment. Now, you can say you can get some relief under tax treaties after the fact, but that's a very slow and expensive process, and it's far from a complete fix. Under formulary, even if different countries had different formulas so that double taxation was baked in to the system, the investor would know in advance what the two different countries are going to do when they apply tax to the income. So if the investor thinks that the aggregate tax rate is going to be too high, the investor can choose to invest elsewhere. But the investor doesn't have to wait until years after the fact to find out about this double taxation. The problem is not one of double taxation, the problem is one of unpredictable double taxation. Arm's length transfer pricing is much, much worse at that than formulary, even if different countries had conflicting formulas. I mean, that is just, I'm glad you asked that question.
So, Michael, can you talk a little bit more about the role of treaties in bilateral discussions about reducing double taxation and whether formulary apportionment systems might actually be an improvement in a bilateral negotiation?
Well, yeah. I mean, you know, in a typical bilateral negotiation now, you'd have, say, the United States and Germany, you know, over the course of 2 or 3 years, figuring out how to split the income from a particular business activity. And they'd have to produce economists, those horrible people, and would take forever. It'd be a very expensive process with all kinds of PowerPoint shows and computer models and whatever. And God knows how it would be resolved. Under a formulary system, if countries had, first of all, if countries had similar formulas, you wouldn't need the double tax processes. You can do away with them. If they didn't have, if they had conflicting formulas, basically what you'd end up having to do is pairs of countries would negotiate omnibus kinds of compromises between their two formulas. And it should lead to a much less expensive and more predictable system than we have today. Now, I should, of course, being I'm a lawyer and Mike's an economist, and between the two of us, I'm sure we could screw up any kind of system and make it unpredictable and expensive. But nonetheless, you would think, based on logically, that formulary would do a much better job of resolving country-to-country disputes, even between countries with conflicting formulas. Joey?
Thanks. This is great. You know, I read my first paper on this in about 1989, but I'm always learning something.
And I read it.
I want to clarify a short thing about the tax treaties, because I worked with Harry at Treasury, as you know, in the 1990s, and we always said, and I think it's been widely known, is that the treaties will be interpreted to fit whatever it is needs to be fit. Just like the arm's length, they adopted profit split by the OECD. So I don't think Harry's point there is that should be taken as the final word. When we did a conference on formulary way back in the 1990s, the point made out of many, and Larry Summers was the Treasury speaker there, the main one, was that it's okay to move to formulary, but you got to do it with other people. You can't go it alone. So my question is, and actually I'm an economist, but we're friends, is the European Union a few years ago put out a fully developed proposal, had everything defined, including a formula. I think formula is great. You know I do. I wrote a book about it. So why not just take their system and say, we're going to go further with allies than by ourselves? So, and Joe knows the details.
I think clearly doing it multilaterally would be preferable to doing it alone. I think for lots of reasons other than a concern about double taxation. I mean, I think the double taxation concern is really a red herring. I think that there are huge efficiencies for multinationals to being able to apply reasonably uniform rules in all the different countries in which they operate. But what I said about economists doesn't apply to you.
Yeah, and I think it's important to know too that the states themselves, although they began in the mid 1960s to move fairly dramatically in the area where they developed uniform definitions under this apportionment concept, and it didn't really take effect until there were 7 countries, 7 states that bought off on it, and then it just kind of exploded out of there. I don't think you need any great critical mass to get it moving, but I certainly agree with you that more is much better than less.
Well, the states, as you just said, the states don't have uniform formulas, and life goes on. But they have, I guess they would have the certainty. Tell me what's bad about, in practice, with formulary apportionment at the state level? Or is it just working perfectly that we should adopt it wholesale right now? Or is it not comparable? Maybe we shouldn't just say, oh, if it's working at the state level, therefore it's going to apply.
I think it is largely comparable, but it's not totally comparable. I think there are significant differences out there, and if you want to point to what is bad in formulary apportionment out there from a theorist perspective, I'm a big believer in uniformity. I would like to see a uniform base across the country, but that's not the way it's played out.
And Congress would have that authority, by the way, if they
Yes.
exercise it.
Maybe.
But there is something about the states, though, is that there are disputes. A formula, by definition, is at some point not going to really have a clear reflection of income in the state or the country. That's going to happen. And so what the states have adopted is a compact where they have basically a dispute resolution system. And there are disputes. And the taxpayer can bring a dispute, or even the state can bring a dispute when they believe their formula doesn't do a clear reflection of income for a corporation in their state. So there are disputes.
Frequently.
And do you want to elaborate on not
Sure.
in particular, but
Sure. The uniform rules, which most of the states that use formulary apportionment have adopted in one fashion or another, have a provision that says that where a taxpayer or the taxing jurisdiction identifies a corporation, or the corporation determines that the formula does not fairly represent their business activity in that state, they can petition the state for some other method of determining, and it's very broad-based. It's in fact, it's the expansive nature of it is virtually any way at the end of the day that does in fact fairly represent their income in the state can be utilized as the basis for apportionment.
There are also some constitutional rules that puts restrictions on the way states can apply their apportionment formulas, and quite technical, but essentially they say that that a state, say, in gathering together the income of a multinational, say Ford Motor Company, can only include income from businesses that operate, that have a nexus to that state. This is the Supreme Court has determined under the Interstate Commerce Clause, so that Ford is free to say, look, we also run a computer business that has nothing to do with the state of Iowa, and you can't include the computer business's income in the national pot that you're apportioning. Those kind of rules that are features of the U.S. Constitution, unique to state law, and some other technical quirks of the way states do apportionment, generate lots of disputes that wouldn't arise under international apportionment. But these kinds of so-called, whether a special apportionment formula applies, that kind of tension would exist in an international system, and is something that needs to be taken into account, objectively in evaluating how things will work.
But
What are your thoughts on the most effective level of aggregation of the taxable income? So, for example, Louisiana abides by the separate entity principle. They only aggregate at the legal entity level. Other states combine that only at a water's edge, and then you have the oil and gas sector in Alaska that combines on a worldwide basis. So based on your experience, what do you think is the most effective level of aggregation of the tax base?
Well, I'm a native Tennessean, which is a separate entity state, but I'm a big believer in combination. I think that combination solves a lot of the problems that we see in income shifting. It doesn't solve all of them, but it really takes out the vast majority of them. I would certainly like to see combination on a worldwide basis.
So for the folks that don't know all those words, when you talk about, you're talking about what the scope of the entity would be to apply the formula to?
That's right.
So would it be the whole world and then apply the formula, just the United States, or just an entity within the United States?
As was pointed out, for the states had a big row about this a number of decades ago, beginning in California and other states, where the issue of worldwide combination came up, and it was litigated through to the U.S. Supreme Court, and the Supreme Court said in Barclays Bank and others that worldwide combination was not unconstitutional. But having said that, as we've heard before about political influence, there was a huge outcry, hue and cry from all over the world about the individual states and the unnecessary administrative burdens and such. And so the states began to back away from worldwide combination, with the exception of states that were impacted by the oil industry, Alaska specifically, Pennsylvania to a lesser degree. But the idea of combination is that entities that have related activities, and there's another factor involved in that called the unitary business principle, that looks to those entities who operate really as a single entity across legal structures, that all of those get pulled together and they have to report their factors on a single report.
And this is just a side note, but I think it's so interesting, I'll bring it up, which is the United States, the federal government negotiates tax treaties with foreign governments, but the states don't have to abide by them.
That's right.
So the United States could spend 10 years negotiating a tax treaty and making all these agreements, and then the foreign government goes, and then California comes in and goes, well, we're taxing you anyway.
Right.
And they just don't understand.
There's an interesting political point, too, in the story Joe has just told. Without getting into the technicalities, which would take a couple days, there is a mechanism called combined reporting by which states, well within the bounds of the U.S. Constitution, can prevent companies from artificially shifting income out of the tax base that's reachable by a particular state. Everyone's known this for many years, but still, what, about 10 or 15 states have declined to enact this for political reasons, because they want to give a tax break, basically, to companies that want to invest in the state. It's when you get complex legal structures, it's possible to hide basically various things under the guise of something very technical when it's really not that technical at all. And this whole debate between combined reporting and separate reporting is a classic example of what's really going on in a political debate being obscured by a lot of basically meaningless technicality.
I want to give the last word to Professor Parks.
Thank you. Just a couple of things. One is, somebody asked a question about what do you do across many countries. 30 years ago, that was a real problem. Today, there are over 95 countries that, under the International Accounting Standard Board, use a standard called the International Financial Reporting System. So you do get reasonably thing. It's the international equivalent of GAAP. The second thing is, Jerry Wegman and I have a paper which builds on Professor Udell's paper, and it's very current, and I have a few copies of it. I screwed up because I didn't send them the thing, but it appeared in tax notes. Yes. And the third thing is that the question of international treaties shouldn't come up in dealing with the $2 trillion because they're already supposedly taxed. And why not use the sales factor in order to go after the $2 trillion? And we've actually written a little one-pager on how to do that, and I have numerous copies of that. And if you want more information on any of these things, salesfactor.org, not sfa.com, which turns out to be the Sandwich Fillings Association of America. But salesfactor.org, not .com, will have lots more information. And I thank you. You guys have done a terrific job.
Thank you, Bill. So that's sales.